Thank you all for joining our current state of investing panel. My name is Nikita Bhatia. I'm a first-year MBA at Northwestern Kellogg. So thank you all for joining our panel. I'm going to hand it off to Michael Kidd, who's our moderator for today, and looking forward to the panel.
Thanks, Nikita. So good afternoon, everyone. My name is Michael Kidd. I'm a partner in accounting firm Mowery and Schoenfeld. We've been a part of the search community for over a decade now, where we provide a lot of services to searchers, search-backed companies, as well as during the due diligence phase. This afternoon, I get the pleasure of moderating the current state of investing panel. And on our panel, we were blessed with 4 individuals with a variety of backgrounds. Tim Bovard from Search Fund Accelerator, Clem Lucas from Relay Investments, Anthony Walker from Next Coast, and Kevin Barton from BankProv. I'll turn it over to them to introduce themselves, their background, and then we can get into some questions.
All right, well, welcome everybody. Tim Bovard, I guess my career, I started it in Europe where I did a 20 acquisition buildup of what became a €500 million group and the largest book printing company in Europe. That led me to teach entrepreneurship through acquisition for 16 years at INSEAD, and then came up with the idea, because I learned about the search fund model after doing that, came up with the idea of creating Search Fund Accelerator, and that was my ticket back to the United States. So created that in 2015, and so we've been supporting searchers ever since.
Thanks. Hi, I'm Clement Lucas from Relay Investment. So my personal background is in private equity, investment banking, and consulting. At Relay, so we have been supporting the search community for many years now, more than a decade. We accompanied searcher in about 200 active search and 130 acquisitions. So we're pretty active in the space, and we're based in Boston.
Is that it? Yeah. Good afternoon, everyone. My name is Anthony Walker. I'm a managing partner at Next Coast. Next Coast is a private investment firm based in Austin, Texas. And we believe that there are 2 paths to entrepreneurship. The first, you have a new-to-world idea that we can fund in the form of a startup. And we have a VC side of the house that funds Series A, Series B investments into new-to-world businesses. I manage and run the ETA investing franchise. We pride ourselves on being a team that combines the experience of myself in financial diligence with 3 former search fund CEOs and operators, 2 of which were the most successful search fund outcomes of all time.
Hello, welcome everybody. Kevin Barton from BankProv. I am the Director of Search Fund Lending at the bank. Some personal background with me. I've been banking for in excess of about 20 years. I would say the last 10 years I've been doing the kind of lower middle market enterprise value deals similar to the ETA space. As far as BankProv, we're one of the leaders in this space. We've been doing search fund lending on the senior debt side. We typically focus on the traditional search model and the traditional search investing. We've probably done in excess of 70, 80 different deals over the course of the last 6, 7 years, and probably have about $400 million under capital. So it's a space that we're dedicated to, we enjoy, and we like working with everyone who's here. Thanks.
Excellent. Thank you, everyone. So I've tried to split the discussion today into about 4 topics. The first one I want to cover is just talking about general current trends that you are seeing in the search fund community. So given all of the experience that we have on the panel today, it'd be great to hear from anyone just what are some of the current trends you're witnessing in search, and then broadly speaking, if there are any other trends that are not occurring within search but you feel should be occurring, any insight there?
All right, we'll kick this off. I would say one, and we're witnessing it here today, is that the number of options that you as prospective searchers have has grown tremendously. 7 years ago, there was traditional search funds and it wasn't even called traditional search funds. It was search funds and then self-funded. And then accelerators came around, and there's all different varieties of that. Now there's family offices coming in. There are people who are specializing in different types, backing different types of searchers, whether it's self-funded or minority searchers. So I think that's the real boon for you all is that there's just a lot of option of who you want to partner with and how you want to approach ETA. I strongly suggest ETA, but it's really important to pick the right path.
Yeah, I might just build on that. And what I would also highlight is that in addition to the number of options, it's the number of people that are pursuing ETA as a career path, right? And so when I think about when my partners, Mike and Tom, did this 25 years ago, there were a handful of folks that were pursuing ETA as a career every year. Fast forward to today, we think there are between 100 to 150 folks that decide to choose ETA in one of the various models that Tim mentioned as a career path. And that's tremendous growth. The asset class has grown at a 30% CAGR over the last 5 years annually. And we think that growth likely continues as the proliferation of curriculum expands to what was originally Stanford and Harvard to now Booth and Kellogg have significant curriculums and infrastructures in ETA, as well as many of the other universities around the country. So I think that trend continues, and it's grown in popularity, certainly, and I think it will continue to grow over the next decade as well.
And maybe building on what Tim was saying and what Anthony was saying is there is also an abundance of capital out there. There are many options that you have. So model is obviously a source of diversity for you to choose from, but there are also many investors out there. I mean, we were at the investor breakfast this morning. It was a room full of investors. It's kind of overwhelming. And so for you, that's a tremendous opportunity to choose the right people in your cap table. You have many options available, and one of the homeworks that you have to do is understanding who's going to bring value for you, for your cap table, for your search in the support, and actually be demanding with the people that you bring on board and you have on your cap table. Ask them tough questions. Ask them, are they going to be available? Ask them the value add. And I think that's really a trend, and it's something that you have to take as prospective searchers into account and to your advantage.
And just to kind of wrap up kind of what you were saying, Clement, is don't get too close apparently, is I think you are seeing in this space a lot of liquidity. There's a lot of investors. There's a lot of experience in this space. And I think as you're going into this space, it's critical to really focus in on building a good board and getting as much equity as you can and really putting a smart team together, because, I mean, we all know what type of environment we're in and what we're going into with supplier costs going up, inflationary pressures, high interest rates. I mean, and as you're kind of going into this environment and you're navigating through this field, you want to have folks on the table that you can call up and ping when you need them, because inevitably you are going to need them. And so it's important to kind of build that strong team.
Mike, I might just highlight one more. And I think that one other area of significant change over the last decade or so has really been the interest of searchers in technology-oriented opportunities as well. If you think about the history of this asset class, the majority of businesses bought were sleepy, old-world businesses where you paid 5 to 6 times EBITDA for a business. You fast forward to today, and many of these businesses are now being valued on an ARR basis. And the most recent Stanford study suggests that 80% of searchers now have an interest in acquiring a software business. That's a significant change, I think, in the interest amongst the folks that are pursuing this, and orientation towards different types of businesses. And I think it's been fueled by the reality that we've all grown up with a computer in our pocket, right? And have a comfort with technology in ways that prior searchers did not, or prior investors in the asset class did not have a comfort investing in those types of transactions. That many of which, in looking at Clement as we look at a number of deals together, embody the same types of characteristics such as recurring revenue and margin profile, maybe at the gross margin line, but similar fundamentals that have really driven really strong returns in the asset class over the last decade to 30 years plus.
Just one last thing. On the use of technology, we are during the pandemic, we were in a remote-only environment. And I think, looking back 5 years from now, it's something that didn't exist at all, the remote option. And obviously you have very different opinions on remote, but you're going to have to, as an operator, you're going to have to make or have the option to acquire remote-only companies. And it's something that, again, wasn't available 5 years ago. And we have a very good example in our portfolio of a remote-only company that is doing tremendously well. And so fundamentally, that's a mind shift for us and for you as searcher and operators in the way you want to operate your business.
And that's a great segue to the next topic, Clem, which is around just the general economic uncertainty and what is happening from an investment perspective. And as it relates to the search fund ecosystem broadly and the companies that are operated by search fund CEOs, my perception is they're very, very resilient to broad economic trends. Are there any insight from your perspective working with the search fund-backed companies as to what creates that resilience? Is it the operator? Is it the business? Is it some combination of the two?
Well, I think one of the first things is everybody talks about reoccurring revenue, and that really is the bedrock of these businesses. And if you have that, then it's going to be much more resilient to a recession, potentially. It can be more resilient to inflationary pressures. It can even be more resilient to something like COVID, which was something very, very unheard of before. So I think that's the most important thing. The CEOs don't come in from birth understanding how to manage in these kind of environments, but they learn very quickly, and that goes back to having the right support, because you need advice. Any CEO needs some advice in times like these, and so that combination can be very powerful.
You know, I think there are two things. When I explain to my wife what I do, I often kind of start with, yeah, I provide capital for folks that are straight out of business school, sometimes 27, 28 years old, that want to be the CEO of a business. And her immediate response is like, that sounds like a terrible idea. Like, why would you ever do that, right? It sounds crazy when you put it in that context, right? But I think what drives that resilience is the idea that this is a extremely driven young person that is willing to bet their career that they can take a small or medium-sized business that is already a pretty good business and make it great, right? But at the end of the day, this is what you've signed up to do for the next 10, 15 years of your life, and you have to make it work, right? And so that level of commitment, that drive, that need for this to be successful, I think that ingenuity is what produces an ability for these businesses to be extremely solid, even in difficult and turbulent economic times. I think the other is more structural in the form of deal structure, right? And Kevin, you're a great partner in this as well. When you think about putting minimal leverage on a business, right, allowing that operator to make some mistakes, to weather some economic challenges without having risk of liquidity events or impairment to the business because of underperformance. When you think about the ability to have seller notes, to have aligned incentives with a seller in the form of rolling equity so that they're invested in the continuation of the performance of that business, I think all of those provide downside protection, and they mitigate risk when things don't go as planned, which I think, as many of you heard in the last panel, oftentimes they don't.
Yeah, I mean, as far as like trends that I'm seeing in the environment, as far as like a deal structure, like when you're talking about multiples right now, I mean, obviously there's some recessionary pressures going on. I don't think necessarily I've seen multiples really getting that much lower. Maybe they've compressed a little bit, but I wouldn't say it's really drastic. I have seen some more push to more earnouts, so it's kind of like, I'm not going to give you everything today, but I'll let you earn it tomorrow if you perform. So I have seen a little bit more of that, especially over the last 6 months. And as far as like how I'm advising is, you know, given the environment we're in, I mean, you know, put a good board together, but also get as much equity as you can. You know, I don't think in this environment you want to make sure that whatever you're going into and managing the company, you want to have some flexibility. So just have a smart capital structure where if things don't maybe go exactly as you planned, you have the flexibility and you have some liquidity, you have some leverage room that you can ultimately adapt and move and switch if things are needed, because there is a chance in today's market that might be necessary, and you don't want to be handcuffed, you know, and not be able to do it if you have to.
So completely agree on what was said, both the quality of the talent, the structure of the deal, the acquisition multiple. There is also fundamentally what searchers acquire. They acquire fundamentally good and solid businesses. And if you go back to the characteristics that we are looking for in an acquisition, that's what also makes the search fund and the search fund, let's say, model or companies resilient in a macro environment that is difficult, right? If you go to the roots of the search fund model, we are acquiring non-cyclical businesses in non-cyclical industries. We are acquiring businesses that are generally displaying steady growth, that are profitable, that are cash flow positive. And so it gives you, to Anthony's point, it gives you a cushion in terms of, when something goes wrong. And the third point is we generally insist on acquiring mission-critical businesses, right, that really have a strong value proposition. And again, in tough macro times, it's very difficult to replace when you have a supplier or have a partner that is providing a mission-critical business. It's very difficult to replace you. And so if you acquire fundamentally a good asset, and to my fellow panelists' points, good asset with strong talent, with a somewhat non-risky structure, I think that's what provides kind of the protection in terms of when you're under economic stress.
And Anthony, you mentioned some of the risks associated with going down the path of starting a search fund or doing an entrepreneurial acquisition. But can you speak to what the trade-offs would be as MBA students are graduating into this uncertainty? What is the risk of starting that?
Yeah, it's funny. I started my career in 2006, and I joined what I thought was a extremely stable investment bank called Lehman Brothers. I made it. It worked out. But I think the reality is, as MBA students, you guys have a lot of choices, right, and opportunities. And I think that there's a perception that job at McKinsey or Goldman Sachs or Lehman is safer than it actually is, and maybe safer than pursuing a search. And in reality, at this point in the business cycle, it's probably the most risky time to be joining that type of business. Conversely, I actually think that there's a significant amount of data that would suggest that this might be one of the better times in the last 20 years to launch a search. There's a significant amount of data that would suggest that private equity firms, companies acquired in and around a recession, have 30 to 40% better performance than businesses acquired at any other point in the business cycle. And it makes a tremendous amount of sense. You're pairing a business that's probably seen some decline in their earnings with a below peak, hopefully below mid-cycle multiple, which provides downside risk to the valuation of what you bought into. And then if you have an average hold period of 5 to 7 years, you're likely selling into an economic recovery, right? These opportunities don't come around very many points in time when you see valuations decline like this. And when you see these opportunities to take advantage of cyclical movements in the marketplace, but when they do, they can often be the best times to invest. And so thinking about this counter-cyclically, thinking about your career counter-cyclically and the opportunity that exists in certain economic periods can be really, really valuable, and this could really be an interesting time to be launching a search, I think.
Just to kind of add on that, I mean, I liked the question when you posed it to us, because I'm like, I'm a little more skeptical. I don't think any industry is particularly safe. I mean, I've been in banking for 20 years, and I was during the crash of 08, so don't tell me banking's safe. I mean, but ultimately, you know, I was having the question about the search, and, you know, rather than going into it from a perspective of what is safe and what is not safe, I love when people are going into it because there's a passion. You know, maybe you have a passion for what business you're acquiring, and you know, it shouldn't be because you want to make money or you think it's a safe. It should be because you have a passion for what you're doing and you want to run that business and you want to go into that industry. And to me, like, that's the right reason for going into something, you know, rather than because you think it's safe or because you think you're going to make money. I mean, I personally.
I think also in today's environment, if you situate this, often we're buying businesses from retiring owners, so age keeps creeping up, but they've gone through this thing called COVID, which was totally unexpected and threw lots of curveballs. Then they had supply chain issues, and that only impacted some businesses, but quite a few. Now we have inflationary issues and the specter of a recession. And at some point, people are saying, and we hear that, you know, enough. You know, at my age, you know, I don't need this amount of risk on my biggest asset where I have most of my money locked in. So this is a great time to monetize it. So I think it is a really interesting time to search.
And the next question I had posed, thinking about you, Tim, and hopefully you won't take this as an insult, but speaking of inflation, you know, most search CEOs, or I would say probably all search CEOs, have never lived through a period of high inflation. Any thoughts around considerations or factors or strategies they should be thinking about, either searching during a period of high inflation or potentially operating during a period of high inflation?
Yeah, no, there's nothing insulting about that because, as you said, most of the CEOs have never done that. None of them have. So I think it begins with making realistic projections in your models, you know, projecting in appropriate interest rates, putting in appropriate cost increases for whatever materials or services that you're selling on. I think that's important. So having a realistic view of that is the first place to start. The other is you've got to, the only way to get out of this is to be able to increase your prices. And we saw this over the last, say, year in a number of our portfolio companies. Organizations seem to be structurally built to resist price increases because it's uncomfortable. Salespeople don't like doing it. People who are making quotes don't like doing it. Systems don't like to adapt to it, or the underlying financial systems cannot adapt to rapidly rising prices and being able to incorporate that in new quotes. And so for a CEO to be able to get on top of that and really get out ahead of pricing and force the organization to increase prices is really important. But then you also run up against structural impediments because you have contracts that are in place, so you're not going to be able to increase your prices until next February. Because in next February, you're not going to be able to increase them contractually more than 3.5% or 4% or something. And yet your costs have gone up immeasurably greater than that. So you have to find ways to get through those contractual discussions. And oftentimes you don't have just contractual revenue, but you have project revenue, where there you have to be very dynamic in your pricing. So you're back to the circus of keeping those spinning plates up and not letting them drop. And it's tough. I really do feel for our CEOs who've had to manage that, obviously, and who will have to continue managing it. But it's a challenge, but you can succeed.
I mean, and that kind of ties into what Clement and Tim, you were saying early when we first began this conversation is, I mean, obviously you're going to call a customer and say, hey, we're going to increase your pricing by 10%. I mean, obviously that's a terrible conversation to have, but inevitable. But that kind of ties into what you're talking about earlier about the stickiness of the revenues and the recurring nature of the revenues. And are these revenues and then is that product set really important to that customer to the point where there's going to be a pain if they have to get rid of it or if they have to change it? And if the answer is to yes, then you're more likely to be able to increase that price without too much pain. If the answer is no, you kind of have a different conversation in your hands.
Yeah, and just an anecdote on that. I'm on the board of a software company, and we had a discussion on pricing, and we pushed them because of the nature of the business. Again, I'm going to the mission critical aspect of the business, and we asked them, why can't you double your prices? And they did. And for some clients didn't even have a conversation. They received the price increase and were like, okay, let's do it. We're going to accept without even thinking or discussing it a doubling in price. So again, I mean, I'm not recommending that every CEO goes to doubling in prices tomorrow, but you really have to think about your ability to raise prices. And inflation, as Tim was saying, is a great excuse to start the conversation because it's out there. Everybody knows about it. I mean, my grandma knows about inflation. So, you know, like everybody knows about it. And so it's a great conversation starter in terms of your ability to increase prices.
But to your point, we tend to think incrementally of 4% price increases, 5%, and now you're talking about double. And so you can ask, well, why not make a 30% price increase or whatever? You got to push and be bold because that's the economy you're living.
So some of these reactions are tactics, but have you seen any drastic changes in the overall value creation strategy that the search CEOs are adapting to related to labor shortages, price increases from vendors, interest rate changes, changes at customer levels?
Yeah, I'll jump in. I'd say that, you know, in some respects, we're still dealing with the impacts and effects of the last downturn being COVID, right? And Clement, you talked about the impact of remote work and the shift towards remote work. And I think one of the most consistent challenges that teams dealt with over the last year has been inflation in labor costs, right? And that's really resulted in, for many new CEOs stepping into roles, and this is not uncommon, when an employee thinks that their company is now bankrolled by new PE investors that have deep pockets, you know, 25% of your employees come and ask for a raise, right? And in some instances, either you're going to give it to them or they're going to walk out of the door, right? And remote work has translated into an environment where it's made it much easier for employees to do that. The offset to that is it's also made it easier for our companies to recruit and hire employees as well, and opened up the range of possibilities in terms of where those employees are domiciled, right? And so I think there are a lot of kind of countervailing forces and impacts that we're navigating across our portfolio. As it relates to value creation, I'd say that the levers largely remain the same. It's grow the top line or improve the profitability of the business, and there are varied strategies to approaching that. I would also say that risk mitigation and downside protection has become a much more prominent point of conversation as well. In thinking about the economic challenges and what that means for your business, stress testing the downside and having an understanding of at what point do we run into covenant issues if we see business decline? How do we react to declines in revenue or EBITDA? Do we need to focus more intently on cash flow and collecting from a working capital standpoint? Are we going to need to make workforce reductions? And that's a very difficult decision to make, but it's incumbent on all of our operators to really be forward thinking about that and try to be not reactive, but proactive in analyzing and making those decisions. But I'd say it's a dynamic conversation at the board level for all of our companies.
And going back to you, Anthony, the transactions that you saw close within your portfolio in 2021, have you seen any downside structure changes, earn-out adjustments, anything like that from just the valuation standpoint?
Yeah, I'd say it's too early to tell for the acquisitions that closed in 2021. You know, I think that we all watch kind of stock market performance intently and see the declines in equity prices. But the lower middle market in some instances are the last businesses to really feel that impact. And so I think many of our businesses have continued to perform according to plan by and large. But for those businesses that have multi-year earnouts, I do think that we're starting to evaluate, you know, is it realistic to think that they will actually hit that target in 2021 or in 2023, right? I think the broader question is one around the importance of deal structure. The importance of kind of mitigating the risk of being wrong as it relates to your growth plan and making sure that as you're closing your acquisition, there are, you know, some off-ramps that allow you to recoup some potential value if you haven't been as accurate as you thought you might be in your financial projections. And earnouts, seller notes are a great way to do that.
Anybody else on the panel, have you seen any big adjustments to recently closed acquisitions?
I mean, I think when we were looking at deals, like, you know, the deals that maybe struggled for our, I think one of the biggest areas of, not concern, but just I think it was the labor, you know, and I think on deals that it was more just, you know, getting good employees to come to work. And I think, you know, through COVID, that became hard, you know, especially with some of the environments in the political areas that we were in, as far as have, you know, people, you know, could kind of stay home. So I think, you know, the labor conversation, as far as like having some flexibility with the remote, can, you know, it can be tough, obviously getting good people to come to work, but it can also be a positive with the remote, because maybe you can obviously recruit people in a wider breadth of a geographic territory that can come back to work where you might not have been able to do it before. But yeah, I mean, the labor thing for me was the biggest commonality. It's just sometimes, you know, keeping your employees and keeping them happy and keeping them vested, and you know, not having them walk out on you, I think that's a kind of a big problem. So
I would say, you know, building on that, none of the businesses that we're buying, or that we've bought anyway, have been involved cost cutting. You buy a business and you're going to be adding costs. You're going to be adding a controller or a CFO, a director of operations, a director of sales, something. So you're going to be adding costs onto it. And I think one of the cautions of today's environment is you got to be very careful not to get out over your skis, of going for growth, building an organization, and then getting kind of caught in a slump in demand or inflationary pressures that compress your margins, because now you've created your own problem that's going to lead to conversations with Kevin and other bankers. So I think you've got to be very careful with that.
Yeah, and maybe on the, you know, planning, from a planning perspective, when we have conversation at the board level, we add a topic, or we add a, you know, part on the agenda, which is, you know, let's plan for the worst. Unfortunately, in a, you know, high inflationary environment, we don't know what's going to happen. So you want to be prepared as operators for not necessarily the worst, but you have to think about it and think at the margin about, you know, what's going to happen if a tremendous downturn and is going to affect your company, right? And so has not materialized yet. Again, we deal with very recession-resistant businesses, but we are thinking about the worst much more than before.
And I guess, Clem, back to you around just the availability of capital to close these acquisitions. Have you seen an increase in the need for gap capital here recently? And I guess maybe just for the benefit of the people who are newer to the community, just explanation of why a gap might exist in the structure.
Yeah, sure. So first, let's start with the gap. So, you know, you're going to launch a search fund. You're going to have your investor list and your cap table. A gap may arise for different reasons, but fundamentally it's because, well, let's say two reasons. The investors in your search fund either don't want to participate or don't want to participate as much as their pro rata. You know, there is a pro rata rights when we participate as an investor in the search fund. So that's kind of the first, let's say, explanation as to which there is a gap. The second is for very large deals, investors, I mean, I talked about availability of capital, but for very large deals, we have a limit, right? I wish I didn't have a limit and I could invest as much as I want, but unfortunately I do, and it's, you know, in my mandate as an investor, I have a maximum check size. And so I'm dealing with that currently. I have a very big, you know, 60 million EV deal on the table, and as you can imagine, the pro rata allocation is very big, right? And so even if I invest my maximum check size, I might leave on the table part of my pro rata because it's a very large pro rata. So that's the explanation on the gap. To your question specifically about capital availability, when I started by saying there is an abundance of capital in the search fund world, so the short answer to your question is no. I don't think there is a capital constraint, and I think it's it's a great way, and it's a great advantage for searchers. I think, for high quality assets, there will be capital available for you if you want to acquire it. And as an anecdote, in 2021, a lot of the deals that we participated in as either gap investors or search fund investors, or search fund investors in the search, were actually oversubscribed. I mean, it's great for you guys. Again, it's great not to have to scramble to find capital. And the only thing I would say is internationally, where, let's say, capital markets and debt markets are not as efficient as they are in the US, there might be a little bit of capital, meaning investor capital, or debt, or a little bit of a pinch there. I mean, the ECB in Europe is catching up to the Fed in terms of interest rate, etc. So there is a little bit of uncertainty around debt availability, let's say in Europe, but in the US, I mean, still we're living in a highly or high abundance world of capital.
Yeah, and I mean, the only thing, I mean, I've been doing like the lower PE kind of stuff for a long time. So, I mean, on a lot of those deals, especially on the ones that were bigger, would do gap, in the form of like mezzanine, and there might be a mezzanine and a seller note and things like that would kind of bridge that cap stack. I would say I didn't see that as much in the search space, but it seems like now as deals have gotten bigger, you're starting to see that more common and more frequently, I'd say. As far as capital, I mean, we're fully open. So, I mean, we certainly look at the business fundamentals as we all do, and it's certainly more not pressure, but obviously that stuff is important. But as far as like that gap, my thing is like, I think the ETA space in banking and doing all the things that I think it's a very specific space. So what I always tell people is, if you're going to use a mezzanine player or a capital player, whoever it is, just make sure they're in the ETA space, because ultimately they're going to understand that space, they're going to be comfortable with that space, and your buddy might work at a mezz firm, and that's great. But if he's not in the ETA space, he might not be a great fit.
So, and I guess the next question is just around the LPs that are behind your funds. So, Tim, are there any communication trends that you're starting to see from your LPs, or any expectations that are changing from their perspective given the current environment?
I wouldn't say.
Sorry, Tim.
That's all right, Anthony. I don't think there's big changes. I think there's more questions of what's going on in the space, because they're removed. Most LPs are removed from this micro market that we're in. They're very familiar with larger PE or lower middle market PE. And so we're very careful about how we communicate, because right now the deal flow is tremendous. We see a lot of activity, both buying and selling. We have a number of exits that we're working on, quite a number of LOIs, so the market hasn't changed in that sense. We do see, and we've communicated this to LPs, that I think there's a little more flexibility with some of the sellers, because they perfectly understand that debt markets are getting tighter, that interest rates are going up, and we obviously use that to our advantage in discussions with sellers. But generally, I think we've been given a very, you have to be very careful when you're talking to LPs. You can't make everything sound rosy, so we try to tamper that down, but we are very bullish on the market, and because I think things in this niche are going very well.
Excellent. So I think we've got about 5 minutes left before we open up the floor to questions. So the last question I wanted to just pose to the entire panel here is around just diversity and inclusion within the space. And the latest Stanford study suggests that there has been progress made in terms of getting more diverse backgrounds into the search community, but the community is still largely white and male. So the question is, how does diversity, both individually, professionally, factor into your investment decisions as you're evaluating either backing a traditional searcher or including them in a cohort at SFA, or the business itself that they're looking to acquire?
Yeah, I'll jump in. And I think one of the aspects that I love about ETA is that it democratizes access to small business ownership across anyone that wants to do this, right? And we all know that entrepreneurship, small business ownership is one of the fastest paths to wealth creation in the US, right? So this is an asset class that provides that opportunity. I do not think that there is a limitation from the investor group in terms of our willingness, desire to invest in folks from diverse backgrounds. I was really encouraged to see the Stanford data in terms of the progress that's made, but a lot of ways to go, certainly. And there was inclusion of new data, and that's extremely important because you can't improve on what you don't measure, right? And so at a portfolio level, we track those statistics. We don't manage to it. We believe in investing in the best and the brightest people, regardless of where they come from, but we're very aware of that distribution and have to check ourselves on if we are being consistent with investing in people regardless of their background, and to the point that we see really high quality people, we invest in them. You know, I do think that there's a broader question about awareness for folks from underrepresented backgrounds that know that this is a potential career path. I think that there are implications, particularly for women, as it relates to their individual risk profile and what it means for them to step into the role of being a CEO of a small or medium-sized business. We've got 2 searchers, one of which had a baby kind of 15 months into her search and had to pause, right? That's a very different consideration than any man has to think about when they decide to pursue this. We had another searcher that had a baby 2 days before her deal closed, which is interesting timing. And that's a different consideration for her as she's evaluating whether or not this is what she wants to do with her life. And as investors, I think that we have to, one, make sure that folks understand that we get that, and demystify that risk as something that the asset class isn't willing to tolerate, and that we're extremely accepting of that and want to see more women participate in the asset class and will support them through that. But also understand that there are different risk tolerances for different groups of people, and be understanding of that and making sure that we're being supportive throughout the process.
Yeah, we actually at the bank are actually carving out its own diversity and inclusion group within the enterprise value lending segment. So we are definitely focusing on it, and it's going to be an important thing. I also think in one of the earlier deals I've done in my career, it was a minority-owned private equity group buying a female-owned business in the food DECA space, which is DECA is basically the Costco of the military. And so when they did the deal, they did a 2% share so that they could be designated as a female-owned business and a minority-owned business. And since the military had a had a requirement as to making sure they were going bids within that space, it created a fairly strong strategic advantage for that company. And so I think there are going to be opportunities within you know, when you're looking at industries and you're looking at companies where it's not just the diversity inclusion is going to be important going forward, but it can be important for the customers who are buying that. And you know, you can, you know, that can be a pretty strong you know, pretty strong avenue. I know for this company it really did help them quite a bit. So
yeah, and I think I mean completely agree with Kevin and Anthony were saying. There is also you talked. Your question is about the search. There is also, I mean, the broader search ecosystem. If we take a step back, is, you know, the investor, and it's the investor panel. So, you know, it's something that we have to talk about. We consider that having a diverse set of voices at the table when we make investment decisions is also very important, right? And diversity in search also comes from diversity in the investor group, right? And so, I mean, we are very aware of that. And for example, at Relay, we try to walk the talk. We try, and for example, 40% of our team is women, and 30% of our team are minority individuals. So, you know, it's something that we obviously care about a lot, and we're trying to obviously foster the best individuals, but also, again, walk the talk ourselves, and as an investor, be diverse.
I'd say our experience, we have no initiative on diversity, none. Our first cohort, we had 4 searchers. 3 of them were either they're minority or non-U.S. born. The 4th one was a dual nationality and a woman. So we couldn't get much more diverse than that. And when we look at going back, since we don't have any initiative to do this, looking back, 30% of our searchers have been either non-U.S. born or minority status, and 11%, which can be improved, are women. And I think in terms of women, I've got 3 professional daughters, a very professional wife, so all for that. There are no impediments to women being in the search community, none. It's just that we don't get that many candidates, and I think that's just generally true. So we always do everything we can to encourage more women to get involved, because I think it's a fantastic career opportunity, and you have clear advantages. The 4 CEOs that we've got are phenomenal, just phenomenal.
That's great. And with that, I'd like to open it up to the floor for anybody who has questions.
And if you do have questions, if you can just come line up here. I think we were told that's the most efficient way to do them. Yeah, you can just come line up here if anybody has any.
Hey guys, thanks for doing this. This is amazing. I have a question about, so you as investors, you get a variety of searchers coming to you. So I wanted to ask, how do you filter those searches? How do you decide who do you want to invest in? And I'm asking particularly because I'm an MBA student. And so right after graduation, I'm thinking about, is it okay for me to go straight into search, or how do I compare myself to somebody who, let's say, has 3 years experience in consulting or has entrepreneurship background?
I'll jump in. So the first thing that I would say is that we haven't been able to find a tremendous amount of data that suggests that someone from a particular background or set of professional experiences is more likely than someone else to be successful in search. What we try to do, because you're right, we do have a number of folks that we evaluate over the course of a year, and to the point of inclusion and diversity, we try to score and rank folks across a number of characteristics that we think are important to have an understanding of your background to be successful. So it starts with your educational background. We try to cut your professional experience a number of ways. Understand the degree that you've worked in sales and marketing. Have you worked in private equity? Have you worked in operations? Have you hired and fired teams before? Do you have grit, tenacity? Do we have confidence that you can convince a seller to sell you their business? We rank everyone on a 1 to 5 basis across those categories. There's no minimum score, there's no target score, but we do that to, 1, get an understanding of your individual qualifications, and then secondly, so that we understand where the gaps are in your background, so that we can surround you with the resources to be successful. So an example, if I know that someone has less experience in doing a deal or private equity, I can spend more time with them working through their financial model and trying to fill in that gap that they don't have. But we, on balance, try to invest in the folks that kind of bubble to the top and have the broadest or highest composite score. And then we're able to compare and contrast folks and say, you invested in this person, they had a really high composite score, you didn't invest in this other person, what drove that decision? We have to justify it to ourselves to making sure that we're being fair across applicants.
Yeah, we have a fairly similar process of scoring and evaluating people on, as Anthony said, background, skills, personality. Again, the search is about selling yourself, your project, and your ability to, again, sell yourself to us, we feel will be, or is representative of your ability to sell yourself to sellers and your project. Again, it's about transition. We're not price maximizers. So there is, you have to have something else, right? So again, same, I don't know about Anthony's secret sauce, and we can discuss that after, but every investor will kind of grade. The only thing that we found out on the data, so very similar, and actually that's great that you came to that realization. We had the same. We tried to look and cut the data in terms of background, private equity, consulting, and stuff. There's no clear indication that background would be indicative of success. The only And I hope there is no statistician in the room because the N is very small, and a statistician would probably scream at me right now. But the only slight correlation that we had is we initially thought that more experienced searchers would be more successful because they have more experience under that belt. We haven't found that is true in the data, and when we correlate exit and success with, let's say, age of the candidate or years of experience, we didn't find, we actually found it was inversely correlated. So just as a data point, again, no statistics, no causality or anything. Don't want to offend any statistician in the room, but that's what we found.
We have a very different way of approaching this, but I won't go into that. But I'd say the number one thing we look for are people who truly, deep down, want to be CEOs. This isn't about doing deals or flipping companies and then going buying a bigger one. It's not about being an investor. It's about being the CEO of a small, medium-sized company and relishing that, truly wanting to do that. And if you've got that's you're way down the curve of getting there.
How's it going? I'll go just a little bit about me. I'm a third generation tool and die maker. I grew up in my grandpa's company. I ended up buying that company and then buying a couple other manufacturing companies that are small. And I learned about searchers and what everybody here is into, and I was like, finding some similarities. I want to know about how you guys, when you structure your investments, I started an SPV to kind of funnel the investments from the SPV into the holding company and the operating companies that I run. Is that something you guys would consider going through that sort of structure, or is it just like direct equity, or how do you do that? And then my other question is, what kind of like returns do you guys look for in your investments?
So a little bit of a likely different financing structure, but typically we finance deals using a combination of equity capital that comes from the investor group, debt capital, which typically comes from a senior lender, and then some combination of seller note, rolled equity from the seller that wants to remain with the business or maintain some ownership of the business. And that mix is typically 30% senior debt.
Depends on the business.
Depends on the business.
I'd say in the senior debt, it's usually like up to 50%, depending upon. I mean, I would say, the most common is like a 25 to 40% equity, same kind of ratio, whether it's seller debt, seller roll, mezz, and then, you're talking anywhere from like 30, 35 to 50% on the senior debt side. So, I mean, and again, a lot of that depends on the industry, and a lot of that depends on like, are you buying it for 8 times or you're buying it for 6 times, right? I mean, so, obviously your percentages are going to change based upon, what the valuation multiple is.
And then what kind of return do you guys normally look for?
I mean, if you look at the Stanford study, if you see mean, average, and the dispersion out there, that's what we're looking for. I mean, obviously, if you're, let's say, So yeah, the way it's structured, I mean, you have 3 tranches, and I mean on the IRR side, and so you will get the third tranche between 20 and 35% IRR, right? And so that's what you should aim for. And obviously, if you have if you want to have your full carry or your full equity allocation, that's the 35% IRR that you should be targeting.
Okay, thank you very much.
Hey guys, I'm Alexis. I'm a Booth alum, and I've been working in tech now for about 5 or 6 years. I was always interested in ETA in business school, but ended up going into the tech route instead. But my question is around, it's twofold. One being, what would you guys say are the differences between going the traditional kind of search route versus, I know we have Accelerator on the panel, and kind of like what are kind of some of those pros and cons? And then also in terms of, I know Anthony mentioned tech being an industry now that's also attractive in this space, and would love to get a sense of kind of what the profile of those type of companies would look like.
I mean, in terms of the model, it kind of comes down to, it's a very personal choice. Whether you want to have this diverse capital base like in the traditional model, or whether you believe that in having one investor who you've developed a close relationship with is better. I have my vision, people have different visions on that. Or if you want to do a self-funded search because you want to find the deal, you want to live in a particular place, you want to search for something very specific where an investor who's looking to have a diverse portfolio and manage their risk would probably not want to back you. But when you find a company, then they'd be happy to evaluate that and back you. So I think the choice of model is incredibly personal. And so you need to just talk to a bunch of people and form your own view on that.
In regards to like the, you know, just to kind of add on what Tim said, in regards to like the traditional versus the self-funded, I think, you know, when I look at that space, you know, we do the traditional. I do think like the self-fundeds tend to be a little bit smaller, and the traditionals tend to be a little bit on the larger side. So, you know, as on the traditional, as the multiples are going up, and then all of a sudden the value is like 20 million, you just need a certain amount of equity and a certain amount of cash to get the deal done. And you know, you might be able to do a few million with friends and family, but when you're getting to like the point where it's like 5 to 7, that's just going to be a little bit harder to do.
Yeah, and I think, you know, the difference between, let's say, self-funded and traditional search, there is a risk difference. There is obviously an economics difference in terms of carry and what you can keep. And there is, let's say, a support difference, right? So I'm not here to convince you to go to the traditional model, because it could be a bit biased on my end. I'm a traditional search fund investor. But you know, self-funded searchers generally find businesses that are on the smaller side, generally sub 1 million EBITDA. So imagine, you know, you acquire let's say 600K EBITDA company, and something happens. Something, you know, you have to either hire or replace, and it costs you $200,000. It's a lot of your EBITDA, like a lot, in your first year as a CEO. And so the impact of 200K, I mean, it's very simple math, but you know, it's very different in terms of mindset and risk when you're talking about a 600K EBITDA company versus, you know, our medium EBITDA is around 2.5, 3 million in EBITDA. Very, very different impact as a first-time CEO. So risk, reward, obviously, I mean, risk reward in finance goes hand in hand, and the the self-funded searchers, yes, get to keep a much larger share of the company. That comes with risk, you know, SBA loans, personal guarantee, and you know, but they get to keep a larger share of the upside and the equity, right? Our model, the traditional model, is we're capped 25% for solos, 30% for duos. That's it, you know. And the economics around self-funded are very different. So it's, to Tim's point, it's really about, you know, what you need and choosing the model that is the right fit for you.
So your second question was around software. So shameless but timely plug. Next Coast just released a white paper on Monday titled SaaS Eats ETA that talks about the dynamic of increasing demand and interest in software companies in ETA specifically, and also tries to pair the characteristics of what you need from a CEO perspective to be successful. But what I would say in terms of the profile of those businesses is that they don't look like the startup-oriented software businesses that we might all think of. These are really self-sustaining software companies. And so simplistically, we think about businesses on a rule of 40 basis, which is effectively revenue growth rate plus EBITDA percentage equals plus 40% as being the type of business that we're looking for. And there's normally some mix of revenue growth and positive EBITDA margin. This is an asset class where you're doing one round of financing, hopefully. You're not having multiple rounds. And so you want to have confidence that that business that you buy doesn't require another injection of capital because it's not producing profitability. And so very different profile than what you might traditionally think about in terms when you immediately think of software.
That was helpful. Thank you so much.
I think we're at time, but we have one more question. Did you want to take the
I
last
have
one?
nothing else to do, so go for it.
Okay.
Thank you, guys. 5 years ago, I helped the founder of a company sell to a new owner, and for the last 5 years, I've been the operator of that business that someone else owns. Over that 5-year period, the new owner of this company has gone and bought several other ones to make a little bit of a micro holding company with like-minded or like companies with like experience. Having watched that model happen, I'm interested in doing something similar as I go to become my own owner-operator. But today, all I think I've heard is a lot of coaching and lessons on how to buy one company and how to get that funded. Do you have advice for someone who has a vision to buy up several companies that would themselves become greater than the sum of their parts?
I mean, we're talking about the initial acquisition, but I think most of the value creation strategies in the ETA world will include acquisitions, add-on acquisitions as part of the growth, not just organic growth. We encourage all of our CEOs to find smaller acquisitions to bolt on, not a similar size transaction where you're going to be merging organization structures and cultures, because I think most CEOs, at least early on in their tenure, are not ready for that, and why should you take that risk? But we've been very successful at buying smaller businesses and bolting them on and growing that way.
I've done that quite a bit in some of my private equity deals, and I would say, one of the more common things that when they are successful anyways, it's, I would say, without question, the number one factor is who they're doing business with. So that does company one and the culture of company two get along? Are they going to be able to sit in a room and get along? Are these people that they can go have dinner and enjoy each other's company? That's a huge factor. And then the other thing that they do that's fairly conscious is they pretty frequently get together. They get together quarterly. There's a lot of face-to-face integration so that they get to know each other. They really truly feel that they're not two separate companies, and that they're one company, and then they can, create some of those synergies by, calling Clement and say, hey, I'm struggling with this. What have you guys done? And X, Y, and Z. And so that, but in order to do that, there needs to be a real, I mean, make sure you're really focusing on the integration and the culture. I think those are the two things that are just really important to make that work well.
Really quickly, just 3 guardrails as you're considering this. I'd say 1, large TAM measured in number of available targets. And so if you're trying to pursue this strategy in an area where there are 5 businesses, the likelihood of you being able to acquire any one of those 5 is probably pretty low. Whereas if there is an industry where there are 5,000 targets, that's probably a better opportunity for you. Second, geographic concentration. It's really difficult to manage a multi-acquisition strategy for assets that are in Seattle and Florida and Washington, D.C. If you can't get to each one individually and you don't have an operator that's in place in each of those individual locations, you just increase the risk profile of that type of strategy. And then third, opportunity for synergies. It's hard enough to run one business extremely well. If you're putting together businesses that don't have any natural correlation or relationship to one another, and that they aren't better together than they would be apart, that can be also very difficult to manage.
Thank you all so much.
Just on the synergy piece, you want to be mindful of, let's say, cost synergies versus revenue synergies or commercial synergies. I remember one of my strategy professor in business school was saying, commercial synergies are like, it's like pixie dust. You can't, it's not something valuable for me. And so to Anthony's point, it's actually a very good point. You should think about, what are the, hard and data-backed synergies that you're going to find by combining those businesses. But obviously, you shouldn't think that it's an easy endeavor. Integration is very tough, and the way we think about it with our searchers is to say, your first acquisition, kind of your platform, has to make sense standalone, because there are a lot of things that can go wrong, and you may not find your second, third, fourth target, right? And so you really want to be mindful of, do I want, and is my first acquisition, my platform, sustainable in its own right? So that's the way we like to think about it, of having kind of a first acquisition that can be standalone.
Thank you.
So thank you to everybody on the panel for participating. Thank you, everybody, for attending and asking great questions. Enjoy the rest of the day.